The market just witnessed a moment that will be analyzed for years to come. Silver did not just climb. It surged with a velocity that stunned veterans and novices alike, kissing the $91 mark. It was a move that felt inevitable to the believers and impossible to the skeptics. But precisely at the moment when the momentum seemed unstoppable, the rules of the game were fundamentally altered. This was not a subtle shift scheduled for next week or next month. It happened immediately following the spike. The CME, the exchange that acts as the central nervous system for these contracts, stepped in and tightened the screws. They raised margins, they increased the strictness of the requirements. They introduced significantly more friction for anyone attempting to hold the exact same position they held mere hours before. That single administrative move instantly flipped the mood of the entire marketplace. We went from a sentiment of absolute invincibility, where traders felt the trend was a runaway freight train, to a sudden, jarring realization that someone else had grabbed the steering wheel. This creates a critical juncture that we must deconstruct today. We're going to break down exactly what happened during that $91 print, why that specific price level matters historically and technically, and what these rule changes actually do to the price mechanics. More importantly, we need to discuss what the next phase looks like for silver, gold, and the mining stocks. You need to stick with this analysis because the shakeout that everyone is about to panic over, the volatility that is about to flush out the weak hands, could very well be the setup for the true move rather than the finale of the story. Before we delve into the intricate mechanics of the exchange intervention, we must establish the context of the rally itself. Silver ran hard into $91, and it was not a gentle staircase climb. It was the kind of aggressive vertical push that makes professional traders sit up in their chairs, makes financial news headlines scramble to find a justification, and makes corporate risk managers start sweating profusely. When an asset moves with that kind of ferocity, it stresses the plumbing of the financial system. Then, the exchange changed the playing field, even if you have never traded a futures contract in your life. And even if you only hold physical metal or mining stocks, you need to understand what this means, because it affects the entire ecosystem, including spot pricing, global sentiment, and the way institutional money behaves. Here is the comprehensive explanation of the mechanism. When margins rise, the trade gets heavier. In the futures market, you are trading with leverage, meaning you only put down a fraction of the contract's total value. When the exchange raises that requirement, you need significantly more cash on hand to hold the exact same exposure. This forces a mechanical reaction. It is not an opinion, it is math. Traders who are over-leveraged are forced to reduce their positions to meet the new capital requirements. It scares others from entering new positions because the cost of participation has gone up overnight. This creates a wave of selling that has nothing to do with the fundamental story of silver and everything to do with liquidity management. This sequence of events creates a pattern that repeats throughout financial history. We see the surge, followed by the rule change, followed by the wobble, followed by panic, and finally, a decision point. The only question that matters for your portfolio is whether that decision point becomes a legitimate, long-term reversal that ends the bull market, or if it is a mid-move fake-out designed to launch the next, more sustainable leg higher. If you have watched markets for a decade or more, you already know the answer is rarely simple or binary. However, the clue is always found in the reaction. You cannot look at the news for the answer, and you certainly cannot look at the opinions of pundits. You must look at the price action-reaction. Strong markets absorb regulatory pressure and keep walking forward. Weak markets crumble the first time the wind changes. Right now, most people are missing this nuance. They are staring at the dollar price on the screen and asking the wrong question. They are asking, am I too late? They look at the chart and wish they had bought at $20 or $30. While nobody argues that buying lower is better, late is not a concept defined solely by price. Late is about positioning a narrative. Late is when the entire world believes the same thing. Late is when the mainstream media applauds the move, when your barber is giving you price targets, and when you feel completely safe buying because the asset has already gone up for 2 years straight. That description of a euphoric top does not match the current reality. Right now, the tone surrounding the metals market is still deeply suspicious. The media coverage is strange, often dismissive or hostile. The major financial networks still treat gold and silver like they are guilty until proven innocent, framing every rally as a bubble and every correction as a return to sanity. Contrast this with the general stock market, where stocks grind higher by inches and get praised like heroes of the economy. When metals move, suddenly the language shifts to words like excessive, dangerous, and overdone. The translation of this media bias is effectively a sign to stay out. Honestly, for the contrarian investor, this is the preferred environment. The explosive phase of a bull market comes when the crowd finally sprints in, abandoning their skepticism. If the establishment is still trying to keep people on the sidelines with fear-mongering and higher margin requirements, we are not at the end of the move. We are likely in the messy middle, the turbulent zone where the biggest gains are usually born for those who can withstand the volatility. We must address silver specifically because it is a unique animal. Silver does not behave like gold, and treating them as identical assets is a fatal error. Gold is a tank. It is steady, powerful, and acts as the ultimate store of value. But it is not built for the same percentage violence that silver exhibits. Silver is the sports car with a volatile engine. It is the metal that can sleep for months, boring investors to tears, and then move like it is possessed for 3 weeks, erasing years of underperformance in a single quarter. This happens because silver holds a dual identity. It is both a monetary metal, responding to currency debasement and inflation, and an industrial metal, critical for solar panels, electronics, and medical devices. It sits at the crossroads of fear and necessity. When money wants protection and industry needs supply simultaneously, silver can gap higher in ways that defy standard technical analysis. That dual identity is why silver's breakouts feel unfair to those watching from the sidelines. They do not politely rise, they explode. Then, just as quickly, they try to throw you off the ride with violent corrections. This brings us back to the CME change. A lot of people heard rule change and immediately translated it into a conspiracy theory that they stopped it. But that is not how market mechanics work. A rule change does not cancel a global trend based on supply and demand. It adds friction. It can force a pullback. It can create a shakeout. It can slow the move and flush out the weak hands who are gambling on high leverage. But it does not magically erase the fundamental reasons why the move started in the first place. Think about the logic of the exchange. If nothing was happening, nobody would touch the rules. Exchanges change rules when pressure shows up. They change rules when volatility threatens the stability of the clearinghouse. They change rules when exposure becomes uncomfortable for the entities guaranteeing the trades. So, in a strange and paradoxical way, the fact that they reacted is a form of confirmation. The move mattered enough to trigger a systemic response. Now, let's talk about the shakeout, because this is where most people lose money. When markets enter a breakout phase, they rarely go straight up in a linear line. They do a thing that can be described as the jiggle, a violent mid-move reversal that looks exactly like a market top. It convinces the late buyers that they were wrong to enter. It convinces the early buyers to take their profits and run. It convinces the spectators that the story is finished. Then, when the emotional selling is exhausted and the leverage has been wiped out, the trend resumes and rips higher, leaving everyone behind. That is the trap. The CME margin change is the perfect ingredient to create that trap. It gives the market a rational reason to wobble. It gives commentators a story to scream about. It gives fear a headline, and fear is the best tool the market has to separate you from a winning position. So what should you watch instead of the headlines? You need to observe the behavior of price at critical levels. Watch whether the dips get bought aggressively. Watch whether silver holds above key breakout zones, even if it dips temporarily. Watch whether gold stays firm while the general stock market gets tired. Watch whether the mining stocks start outperforming the broad market on a relative basis. Those relationships tell you where the capital flow is actually going. Because the real story here isn't only about silver. It is about rotation. We are watching capital slowly shift away from overcrowded trades in the tech sector and the S&P 500 and move toward hard assets. Not everyone is doing it yet, and certainly not the general public. But the early flow is visible if you stop staring at the surface level. The S&P can print new highs while feeling exhausted, driven by only a handful of companies. It can crawl forward and still be in a phase of distribution where smart money is selling to retail. Meanwhile, gold can surge and still be ignored by the masses. That combination is often the early stage of a regime change. When regimes change, ratios matter. One of the cleanest ways to understand the silver move is to think about silver relative to gold. Over history, there have been moments where silver reached a much larger percentage of gold's price than it does during sleepy periods. Even after a big run, silver can still be cheap relative to gold if that relationship hasn't normalized to historical averages. And that is why the upside can be dramatic. It is not because silver needs a fairy tale to justify higher prices. It is because the mathematical relationship can stretch back to the mean. Now, we must bring the miners into the picture. Mining stocks are the leverage play that most people either love at the top or hate at the bottom. The reason most investors get burned by miners is that they trade them like emotions instead of a structure. Here is the structure you need to understand. The mining sector is infinitesimally tiny compared to the ocean of money in broad equities. When even a small percentage of capital rotates out of bloated index exposure and into the mining sector, miners can move like rockets. That is not magic. That is liquidity math. The other structural point is valuation. For years, miners have been priced like a dead industry. Some of that was deserved due to cost inflation, share dilution, and chronic mismanagement. But long neglect creates long opportunity when the tide turns. If you are still haunted by memories of miners collapsing during past equity chaos, understand that the setup depends on relative strength. If miners are breaking higher relative to the broad market, the condition is different. It suggests money is choosing them, not abandoning them. And that is the kind of signal that can precede a powerful multi-month run, especially when the metals themselves are showing strength. We also need to talk about why the CME move feels personal to people. It highlights a fundamental truth about our financial system. Markets are not a pure democracy. They are a system with gates and gatekeepers. When the gates tighten, smaller players feel it first. The hedge funds and bullion banks have deeper pockets to meet margin calls. The retail trader often does not. This creates anger, distrust, and ironically, more interest in owning the asset outside the gate. That is why these rule changes can backfire narratively. The more people believe the game is being managed or rigged, the more they want exposure to assets they can hold physically, not just paper claims that can be altered by a rule change. This creates a divergence between the paper price and the physical demand. Let me ask you to reflect on this. Do you believe the CME rule changes are simply responsible risk control? Or do you think they are a way to protect certain short positions from a runaway market? The answer to that question often dictates how you trade the aftermath.